Good morning, social media. This is Rushdi Rauf with Century 21, and today I have the pleasure of having Varan Karunanantham with iConnect Mortgages. Thanks, Varan, for spending a Sunday. As a family man, I know what Sunday means, but we have some great content coming up.
And thanks for having me, Rushdi. It's been a pleasure working with you and your dad, as always.
So, Varan, we work with a lot of newcomers to Canada and also people looking to get started off on their real estate journey. What would you, in simplest terms, explain how a variable mortgage and a fixed mortgage, how they differ?
When it's come to the variable and a fixed, it's very simple. The variable rate mortgage, the payment and interest rate is not guaranteed. When you take a fixed rate mortgage, payment and the interest rate is guaranteed for the base on the term that you are choosing. But there's a total myth, always you take a 5-year fixed, but it all comes down to the need of the client.
Right.
And especially in a high interest rate, in a declining interest rate environment. I know we had a peak of the interest rate and it's going to be coming down. That when the rate cut begins, the fixed term will be coming down as well. So 5-year rate is a myth. It's a stigma. Everyone wants to choose a 5-year term. That's also come with a lot of prepayment charges if you want to move. Average size of the mortgage in Canada is 2.3 years.
2.3 years.
2.3 years. So what that means is you will be doing some kind of transaction every 2.3 years.
Even though a term could be as long as 5 years.
Correct.
Wow.
So let's say, for example, if you are with the one lender and you want to do a purchase or you want to upsize your home, if you don't qualify with the lender, you need to go to a different lender. It's also come with a hefty penalty as well.
Right.
So as a mortgage broker, mortgage agent, my job is to understand the client's short-term and the long-term financial goals and recommend the product. But if you want a fixed payment, then you go with
and the peace of mind of static payments, right? Yep. Nice.
And especially for the first-time home buyers, they prefer a fixed payments because we have seen what happened over the last 2 years with a high interest rate environment. But variable rate payment will go up when the interest rates start to go up as well.
So amongst the mortgages that are coming up for renewal between now and the next 18 months, I think I read that it was 60% of the mortgages have an interest rate below 3%. When they come in for renewal, they're looking at much higher numbers compared to the 2.5 or 3 that they had. What are the options that are out there for those clients?
Rushdi, this is like a biggest focus even in our business as well. It's going to be a huge renewal market coming up for next 18 to 24 months, 12 to 24 months, I would say. One of the biggest challenge the clients, our clients, or all the consumers going to have is the increase in payment. We're never going to get a rate below 3%. 3%. It's not going to happen. Let's be realistic over the next 12 to 24 months, right? So how my approach for the clients would be, I believe in a cash flow. Yes. In order to keep the property going, it's a cash flow. So we have to look at the overall financial profile and the picture of the client. And if they have any unsecured debts or credit cards or line of credit, maybe we should look into consolidate all the debts to bring the cash flow better.
Right.
So that's the number one reason they can manage the high interest environment. And option number 2, find additional source of income. You could have bought a house, you don't have a basement apartment. Maybe you can refinance and take the money out,
get into a rental,
make an apartment, and that can create a cash flow for you.
Nice. Yeah.
So you have to talk to the mortgage professional and explore all the options.
Correct. Yeah.
And if still comes down to an affordability issue, maybe you should talk to your realtor and selling the property or downsizing it or look for a different option.
There's no one right answer for all.
There's no one right answer. It's like an art, right? Everyone's going to have a different scenario. But I've been preaching to my clients, if you think it's going to be out of your hand to keep it affordable, maybe swallow your pride and sell your property or look for different options.
So Varan, amongst the lending options out there, there's also the alternative lending part, which is, I think, on specifically on the private mortgage side. Do you want to just elaborate a little more on that with what options are out there?
Yeah, absolutely. So as a mortgage broker, we work with the major banks, TD, BMO, Scotiabank, and B lenders, such as Home Trust, Equitable Bank, and also there's a private mortgages as well. So there's a stigma about the private mortgages. Private mortgages, I understand it's cost high interest and affordability is an issue, but it depends on who the end users are.
Okay.
We worked with a client recently. They are investors.
Yes.
And they understand what the cash flow from the property that's going to come in, and they understand what the appreciation of the property is going to be in the future, and private mortgage was the only option for them to get into the market. Even if you look at the interest you pay on it and the cash flow they're bringing it in, affordability wasn't the problem.
Correct. Yes.
So it comes down to the need analysis of the clients to make sure it's the right product. If it's the right product, it's not a bad thing to explore the option to build your real estate wealth. I think in this situation, the client we have, they are building the real estate portfolio and they are building a real estate wealth using a private mortgage.
Yeah, and the cash flow part does help with the outflow of it.
Absolutely. Rushdi, so we come across a lot of clients. They are new to Canada, young families. The house prices are going up, and the interest rate has gone up. What are you telling them how to get into the market? So, what are the options they have? One
thing that we do is, if there are younger families who are coming in, but they do have more than 2 people in the family, and now they need a minimum of 3-bedroom home or a townhouse to start off, and it not necessarily is achievable right now. What we look at is continue living, either if it's with parents, or if you're renting out, continue staying as long as your present accommodation is taken care of. Get into a smaller real estate portfolio, maybe a 1-bedroom apartment or a 1-bedroom condo within the GTA. Have that rented out. At least it kickstarts the process, and you're keeping up with the GTA real estate market as well.
So you can bang on the appreciation.
Exactly. So because saving and trying to keep up with the savings is not as easy as leveraging out the property.
When you start saving, the house price is going up. It's a catch-up game. You're never going to catch up to it. At least you're getting into the housing market. So you're actually taking advantage of the appreciation. And once you kind of establish yourself and cash out the property,
expand out. Let's say for somebody who has home ownership within a 2 or 3 year plan, what are things that maybe they should look out for between now and then? So, or also avoid,
Number one thing is everyone wants to come in and they want a transportation, especially if you live outside of Canada, outside of GTA, want to commute, car payment, car loan. Car loan is one of the biggest concern when it's come to qualify for the mortgage. And the car loan is actually not cheap anymore because the interest rate has gone up on the auto financing as well. So try not to have a car loan, or if anything, buy a used car with your cash. So don't have a car loan. And never miss a payment. Even if you don't need a credit card, you live with a family, build your credit. What that means is have a credit card, pay it off, use it, and make sure you pay it off. Use a credit card as a debit card.
Yes.
Okay. And don't get into helping your friends and family to co-sign because you don't know their financial situation. You could be here for a little bit longer, and a lot of people come and say, "Can you help me with the loan? Can you help me with that?" Be mindful because co-signing is same as you are taking your own loan, and you don't have a control of someone's payment. I have seen people end up in paying someone's debt, even though it doesn't.
You see the fuller picture.
It has biden a lot of people without even realizing. And then the other advice is keep up the payment on time. Right? Keep, at least a minimum payment. You may run into some financial difficulties, and try to make sure you have to keep up the payment on time. And most important thing is there's a lot of stigmatization. Keeping the payment is the one great thing, but don't over leverage your credit limit. So when you go 50% above the limit, that brings your credit score
down.
Right? So try to keep the limit below 50% on all your credit facilities.
Also, Varan, so one question that we get is when somebody is looking at buying the investment property or the second home, to use a holding company or a holding corporation to purchase that home. Anything that you see as an advantage in that?
I want to make it clear, I'm not an accountant. This is something you need to talk to an accountant based on your financial situation. The answer will be no. I have done enough research, spoke to multiple people. It doesn't make any financial sense unless you own more than 10 properties. Even at that point, it's actually help you in terms of the liability purpose, not in terms of the financial purpose.
Not really.
What happens is when you sell the property, the money go to the holding company, then the money has to come to your hands.
As a dividend out of it.
So you still end up paying more taxes. But short answer of it, it doesn't.
It does not. Okay. Good. Thank you.